When I was asked to lead this conversation, it was an opportunity that I could not pass up. Making wise financial decisions for ourselves and for our loved ones requires us to stay informed, and free webinars like this one are very empowering. So please pat yourself on the back for making time to join us today. We will jump over to the presentation in just a minute, but first, a few housekeeping items. We are in a webinar format, which means your microphone is muted and your video is off. This event is being recorded. You can type questions into Q&A, not the chat box at the bottom of your screen, using the button with the two conversation bubbles on it. At about 12:30, we'll jump to the questions that were submitted when you registered, and then we'll get into the questions that you'll submit here. I'd now like to introduce our presenter today, Joseph Enriquez. Joseph is a partner and a member of the Trust, Estate Planning, and Administration Group at Chase, Rutherford, and Freeman, which has offices in Boston, Providence, and Westerly, Rhode Island. He concentrates his practice in the areas of estate planning, including the preparation of wills, trusts, power of attorney, as well as the settlement of trusts and the administration of estates. Joseph has been a featured speaker on estate planning issues at business associations, community groups, and educational events. He also is a past member of the Ethics Committee in the Boston Bar Association. I am thrilled Joseph is here with us today to share his knowledge and his expertise in this free webinar. We can't wait to learn from you, Joseph, so please take it away.
Thank you so much, Shaylyn. It is a pleasure to be here. Like you, I come from a family of educators. My wife is a teacher. My mother was a teacher. My sister's a teacher. But ironically, my mother had a second career as a children's librarian in a town down on the South Shore for about 20 years. So she certainly made an impact there by way of using the educational platform of the library to help young children, young families, and young adults, and all adults learn to really appreciate the benefits of the library and how it can be so impactful to all of our lives. So today we're going to be talking about estate planning, particularly in a dynamic tax environment. We are in one of those environments now, and we are now going to explore some of those issues and how they impact one's decisions on estate planning. Just a little quick business about my firm. We do a lot of different work, trusts and estates, as Shaylyn mentioned. We also do work in business, corporate, real estate, litigation. We do some work in environmental work, environmental permitting, some work of redevelopment, properties that have had environmental concerns. We also do a little bit of bankruptcy and receivership work for some particular clients. Next slide, please. Some of the key terms that will come up in the presentation today, as well as things you may hear as you're exploring the world of trusts and estates, are a trust, which is just a legal entity, a legal document where someone is in charge. That person is a trustor or trustee. The trustee. The trustor or the grantor gives property to that trustee to manage for them. And they're responsible, the trustee, for managing the property, making sure that it is protected, and ultimately getting it on to the beneficiary. And trusts are generally either revocable, meaning they can be changed or revoked, or irrevocable, meaning they cannot. A will, or last will and testament, is the document where someone describes what they own, who they want to be in charge, and what are their final wishes for what's going to happen to their property after they die. It's also important if someone has minor children that they nominate a guardian to take care of those children in the event that one or both parents have passed away. The grantor is the person who sets up a trust, and they put the property into the trust. They decide what goes in, and they direct how things are going to go by way of the terms of the document. The beneficiaries are those who will receive the property from the trust and or from a will, and their responsibility, if it is to make sure that they take the property and do what the trustee or grantor has directed them to do. The trustee is a fiduciary. They are in charge of managing the property in the trust. Their job is to not do what they want to do, but to do what they've been instructed to do by the terms of the document, looking after the beneficiaries of the trust. And sometimes where there are multiple beneficiaries and multiple generations, they have to strike a proper balance between growth of an asset, payment of income, and making sure that the property is protected. In a will, the person who's in charge is known as the personal representative. For generations and generations, that person was called an executor. But in Massachusetts, we use the term personal representative. The role is the same, though the name has changed. And their job is to follow the wishes that are set forth in the will. A bequest is simply a gift. It's going to someone through the will, and they're going to take the property and then make use of it. A charitable remainder trust is a special type of trust where property is given, it's then available for the use of a non-charity, and then the remainder goes to the charity for their benefit. And a gift is, as very commonly used, just something given free of charge with no consideration, and it's available for someone to use right away, generally. Next slide, please. So estate planning is really about leaving your legacy. What are you going to leave behind after you've passed on? And there are four major components. First, you memorialize your wishes. What do you want to do? Second, you provide who's going to receive the benefit of what you've worked so hard for, your family, your loved ones, friends, charities, who knows? You can decide those things. The third factor to consider is, how can I give my property in a tax-efficient manner? How can I make sure that most of what I earned and worked for in my life will go to the people who I want to receive it, while paying the least amount of taxes? And fourth, while doing all these other steps, 1 through 3, how can I also take advantage of the law to help the charities who I want to favor, maybe a charity that you've worked with during your lifetime, or one that has been of benefit to you, and now you want to repay by making them the beneficiary in some portion of your estate plan. Next slide, please. So with regard to estate and estate taxes, an estate tax is money that one has to pay to the federal and or the state government based upon the value of your estate when you die. There are exemptions to the amount that you have to pay. In other words, you don't have to start paying on $1. You get a certain amount that is exempt from the estate tax. On the federal level, the estate tax exemption is about $13.99 million for 2025. Massachusetts has an exemption amount as well for their estate tax, which is $2 million. Rhode Island, to our south, has an estate tax of just over $1.8 million. Connecticut, a little bit further south or west, has an estate tax that is tied to the federal estate tax exemption amount. Looking to our north in New Hampshire, and then way further south to Florida, there is no estate tax in New Hampshire or Florida, which is why they're becoming very popular for retirement relocations after the working life has ended. One thing to note, it's okay, is that the federal exemption is going to be changing, which brings us to this tax environment that we're in right now. In 2017, excuse me, there were a number of tax changes to income tax rates, to business deductions, and to many other factors that go into the tax code in an effort to boost the economy. However, one of the largest that will impact many people is that the estate tax exemption effectively doubled. It went to $10 million at that point. And with indexing to inflation, it is now, in this year, 13.99. Now, the 2017 law is going to sunset at the end of this year, which means that if nothing changes, as of January 1, 2026, the federal exemption is only going to be $5 million. Now, with indexing for inflation, it may be somewhere between 6 and 7 million, but it still will be a very significant decrease from the current state of the law to 2026. Some additional things that may change are income tax rates. The way that businesses deduct expenses, and how tax-through entities are charged. We have a Congress that is very close between one party and the other party. How they work together, and if they can work together, is going to have a significant impact on the estate planning process. Next slide. So some of the ways that we are talking to our clients about taking advantage of the current estate tax exemption amounts, not knowing whether they will or won't change, is through the use of irrevocable trusts. And three of the most commonly used trusts are the Dynasty Trust, the Spousal Lifetime Access Trust, and the Irrevocable Life Insurance Trust. So a dynasty trust is the type of irrevocable trust that is designed to pass property from generation to generation to generation. It's with the least amount of federal estate tax bite. One uses their annual gift tax exemption, as well as the generation skipping transfer tax exemption, and applies that to the funds they're putting into the dynasty trust, thereby letting those funds pass from one generation to the next without a federal estate tax hit. A spousal lifetime access trust is a way for one spouse to transfer money irrevocably to a trust for the benefit of their spouse. That beneficiary spouse has the right to the income from the property and can, in certain circumstances, access the principal. The benefit of that is that the spouse who is granting the property can, with the cooperation of the beneficiary spouse, still get access to the assets that have been transferred to the trust. Now, the IRS has gotten somewhat wise to this and has said if two members of a couple decide they're going to do a spousal lifetime access trust and they set up mirror image trusts with same trustees, same terms, same beneficiaries, the IRS will disregard the transfer entirely, and they will consider all those assets to still be owned by the original owner. So it's important that one doesn't just grab a form off the internet and try and do their own spousal lifetime access trust. They need the advice of an attorney to make sure that those terms are going to be done properly and that that reciprocal trust doctrine can be avoided. And then another important and common irrevocable trust that is used is an irrevocable life insurance trust. When someone dies owning life insurance, even though those funds are going to be paid to the beneficiary outside of the probate process, the value of that policy is included for the person who is the beneficiary of, who is the owner of the policy. So the person who is the owner of the policy with a $2 million or $3 million policy for the benefit of their spouse and children will have that policy included in their estate and may have to pay estate taxes on it. However, if they've set up this irrevocable life insurance trust, then those trust assets can be removed from and not counted in the estate tax calculation. Next slide, please. So some of the things that one can do on the income side while we're under the current law is consider your IRA withdrawals. Do you want to take more money out now beyond your required minimum when you are in a lower tax environment? Do you want to consider a Roth conversion? And do you also want to perhaps consider upping your charitable contributions during this year? Or after you talk to your tax advisor, maybe you want to save some of those for 2026 when the law may change about how one itemizes deductions. Next slide, please. So in terms of gifting, there are a few different ways to consider how you can use gifts to reduce your estate, but also provide a benefit for those who you want to be generous to. Lifetime gifts, giving property away while you're alive. You have the benefit of seeing the person receive the gift and of making sure that they're doing what you want them to do with it. Now, when you give it away, you can't always control what they do with it, but if you use it in a certain way, for example, paying tuition for a grandchild or giving money to a local homeless shelter, you can see that they're using the money in the proper way. One can also give charitable gifts upon their death. They can include that in their trust planning, or they can include it in a will. And that way, once they passed away and their estate or their trust is being administered, then a check will be sent to that charitable entity with the benefit of the person who passed on, knowing that their funds are going to be put to good use. The charitable remainder trust, which we mentioned earlier, is another popular and effective tool because the charity gets the use of that money after the person passes on, and the appreciation of those assets also goes for the benefit of the charity. One could also consider, if they're over the age where they're taking their required minimum distributions, to maybe funnel some of that money off to a charity. Maybe one is getting their required minimum distributions because they have to get them, but they don't really need those funds. It's not necessary for them to maintain their current lifestyle. So having those funds go to a charity can be a wonderful way of sharing the benefit of one's success. Next slide, please. So in terms of giving gifts, one may ask, well, how much can I give and do I have to pay taxes on it? Well, there is a gift tax on the federal level, and there's also an exclusion there. So annually, one can give away $19,000 per person per year without having to worry about any estate taxes, any gift taxes. If one wants to give more than $19,000, one can either file a gift tax return and pay the gift tax, or they can use some of that 13.99 exemption amount, which is good for lifetime gifts, as well as the estate tax, and apply some of that during their lifetime. That will avoid gift tax in the current year, but it will reduce the amount of exemption available at death. So that is a way to save on current taxes. Charitable bequests are also an effective way because the estate gets a deduction for the amount that's going to charity, which reduces the estate taxes that an estate may have to pay, reducing their taxes. Next slide, please. So the charitable remainder trust in a little bit more detail. The present interest in the trust would go with the person who's granting it. So for example, if one gave a gift of appreciated stock, the dividends may still be paid to the grantor, but the principal, the underlying benefit in that share, in those shares of stock, would ultimately go to the charity. You do that in the form of a trust, and making sure that you have a proper trustee involved, and that the beneficiary you designate is one which is going to be around for a while. We often recommend people that if you want to benefit an organization, for example, like the Boston Public Library Fund or American Cancer Society, you can be very confident that our organization is going to be there in another 15, 20, or 50 years. But a smaller charity, maybe you want to consider naming that charity, but also naming a successor who will be continuing their particular mission in the event that that individually named charity is no longer in existence at the time that the trust would be terminating and paying out. So the benefit is that the grantor, the one who's giving the funds, gets to take a deduction for what they've given. The charity gets to have the asset, which sometimes is a low basis asset, and then they can have the appreciation grow for the benefit of the charity. So money is taken out of the estate of the grantor, removed. They won't have to pay estate taxes on that when they pass away, and the charity gets the benefit. Next slide, please. So a little more detail about IRA gifting. So one can take their required minimum distributions, and one can say, I want to make a qualified charitable deduction from my IRA. One can say, I want to benefit the Red Cross or another charity and make that a direct contribution. One can give up to $100,000 annually without having to worry about any tax consequences. And because that money is coming out of the IRA, which would otherwise be taxable in the taxable estate, you're also reducing the ultimate estate tax bite and benefiting the charity. Next slide, please. So when one is planning the estate, their own estate, they need to have an appropriate team. They should work with an estate planning attorney, with a financial advisor who has a view of the big picture of the individual's assets and debts and other goals that they have for their finances. And one also should have their accountant involved, who will be able to advise specifically on the tax impacts of a particular plan. Now, the estate planning attorney and the financial advisor will also have an understanding of the tax impact, but it's important that the CPA or tax advisor is also involved in that process. Some of the things you should consider. Is my estate going to be taxable? One may say, oh, probably not. I don't consider myself wealthy. But if you consider the value of a home, particularly in the greater Boston area, if you consider the value of life insurance that may be in an individual's name, if one considers retirement accounts, with all those things being subject to estate tax, it is not hard at all for someone to get over that $2 million Massachusetts estate tax threshold, even if they may be shy of the 13.99 federal exemption amount. So how can we plan to mitigate the benefits or the bite of the estate tax? Benefit came to my mind because as an expression we use, don't make the IRS the beneficiary of your estate, because nobody wants to pay any more taxes than they have to. And then again, what would you like to do after your death? Who do you want to benefit from your hard work with the generosity that you have? And I think we are at 12:25, so maybe time for questions now.
All right. Thank you, Joseph, for that. Questions submitted prior to the webinar. First one is, any advice when hiring someone to help me with my will?
Yes. So first, go to someone who has experience in this field. Not every attorney has experience doing estate planning, and not every attorney who does wills really has a full understanding of the impact of an estate plan across various different areas in one's financial situation. Go to someone you're comfortable with. If you have a meeting with an attorney and you just don't get a good feeling, by all means, get a second opinion or a third opinion or fourth opinion, because this person is going to be doing documents and crafting a strategy that is going to impact you and your family during your life and after your passing. So you want to be comfortable with that person. And then I would say, don't try and do it yourself. All the time on TV and on the radio and on the internet, you see ads for do your own trust, get a document online, you can do it yourself. It's drafted by attorneys, it'll be good for you. Really, the person who's putting that out there and the companies that are putting it out there, they're looking to sell you a product. They're not establishing a relationship with you. They're not getting to know who you are, who your family is, what your goals are. They're not going to be in a position to be able to give good advice on your particular situation. And if something happens and you use those services and then those companies are gone, bought, sold, where are you going to be at that point? So might as well get involved with an attorney right away, an experienced attorney that you're comfortable with, get the process started and get that relationship going.
All right. Question number 2. How do I know if a living trust or a will is right for me?
So that's a good question. And it depends on the circumstances that a person is in. Also depends on the amount of assets they have and how they'd like to manage them. A trust is a way to keep property out of your probate estate, which means it will pass under the trust as well as and not under the will. It's going to be separate from what's in the will. So knowing what you have, how you want to manage it, and who you want to be in control of that property can be important. And this also is a situation, or comes up in situations where you have second marriages, or where you have children of one relationship, and someone is coming into a relationship with children from a prior relationship, and you want to make sure that each side of the family or each group of children, because it could be his, hers, and ours, um, you want to make sure that they can all be treated fairly and properly. And so trust planning can be important in that way. Also, if you have people who are in your lives who may have disabilities or substance abuse issues, you can use trust planning to make sure that they can receive some benefit without impacting their eligibility for governmental benefits.
Question 3. I see a lot of advertising for creating a donor advised fund. Is that a smart way to manage my donations?
So it can be. So a donor advised fund is something where you work directly with the investment company. You talk to someone like Shaylyn and say, I want to take a part of my assets and I want to donate them. I want to set up an individual or charity or groups of charities who are going to receive the property. And that way, you know your funds are properly managed, you know the charity is getting the benefit, and you're getting the deduction up front. So it's important to, if you want to use a donor advised fund, to work with a qualified advisor who has experience in that field. Now, the attorney can be involved in working with the advisor, reviewing documentation, reviewing the donor advised fund agreements to make sure they're doing what you want them to be doing.
And I think just to piggyback off of Joseph, a donor advised fund is a wonderful tax efficient vehicle, especially if you're making consistent donations. But it is important to keep in mind that once you make the contribution into that fund, you can no longer use the funds for personal use, which is why working with a financial advisor to put together a financial plan so that you can really look at your total balance sheet and take into account what your other future cash flow needs are on top of what your personal giving goals are to determine if a donor advised fund makes sense, and if it does, exactly how much you should be funding it based off of other goals. All right, question number 4. Does your firm ever act as a personal representative for clients who have no living relatives or friends? What do you advise people in this position?
So we do. And it is sometimes comes up in that particular situation. Someone doesn't have close family or friends in the area, or maybe they have family, but there's an estrangement, or for some other reason they don't want their family involved. And we can do that service, and we would act as the personal representative for the administration of the estate. And we also do the same service acting as trustee for trusts that people set up.
Awesome. Question 5, how do estate taxes work if the beneficiary is in a different U.S. state?
So the estate is going to be administered where the person who died was domiciled. So if you have someone who died in Massachusetts, Massachusetts will be the forum where the estate is administered. And if someone is a beneficiary who happens to live in Georgia, everything will be done in Massachusetts, and then ultimately, when the estate is settled, the check will simply be put in a FedEx envelope, or there'll be an electronic transfer of funds, or however they want to do it, down to the beneficiary in that other jurisdiction.
We have a lot of questions coming in. We might not get to all of them, just to keep in mind. We will provide you our contact information and in a follow-up email, so if your questions do not get addressed. But moving on to the next question, if all assets identify a beneficiary, is there a need for a will?
Yes, because even though someone says all of my assets have named beneficiaries, they often miss one or two or several things. Number one. Number two, if there are minor children involved, you want to have a guardian named. And number 3, sometimes an asset comes to an estate where you didn't even know you had it. We've had circumstances where people have died and their estates prosecute wrongful death actions, and now all of a sudden there's a significant recovery, and it's part of the estate, And if there was no plan involved, then it goes according to the laws of intestacy. Whereas someone may want to leave the property in a different manner, maybe to one of their 7 children or to a charity or otherwise make a different distribution other than what state law requires.
Question 7, can you put your 401k into a trust?
Not advisable, I would say, and Shaylyn probably would agree with me. The tax benefits of the 401k and the distribution to the beneficiaries is better done outside of a trust structure. We do put some fail-safe language in our trust documents in the event that retirement accounts ultimately end up there, so we can comply with the Secure Act. However, it generally is better to keep those outside of the trust.
I would agree. Question 8, how do I find an estate attorney and what is the range of fees?
So probably would be talk to family and friends, talk to your financial advisor, talk to your accountant, see who they may have worked with in the past and they're comfortable with. You could also contact the Massachusetts Bar Association or the Boston Bar Association. Both have lawyer referral service programs, and those attorneys sign up to be participants in the program. And then you can get a number of referrals for people in your area if you want to work there. And fees for attorneys in this area vary. Some attorneys do work on a flat fee or fixed fee basis. Some do work on an hourly rate basis, and some do a mix depending on the type of work involved.
Question 9, can you review the estate tax thresholds again, federal and Massachusetts?
Sure. The federal is 13.99 million for an individual. And for Massachusetts, it's $2 million. So again, any amount below that is going to be not be subject to the estate tax.
Question 10, will beneficiaries be taxed?
Well, when someone inherits property, that in and of itself is not a taxable event. However, someone may end up having taxes owed on the appreciation of the asset, or when then they sell the asset that they receive, they may have to pay capital gains on the difference between the basis that they received from the person who passed away and the value of the property when they sold it. Which is why basis planning is also an important part of tax and estate planning, to do our best to try and get assets to the beneficiaries with the highest possible basis. There's a general step up in basis principle in the law. When someone dies, their assets are stepped up in value to fair market value for the date of death, but that also depends on how the asset is titled at the time of death.
Awesome. And our last question is there a life event that signals one should get a life estate plan in place?
So yes, and there are usually 5 big ones. Marriage, divorce, birth, death, and retirement. Those are the big 5. So if you're getting married, or if you had a divorce, you have a birth of a child, death of a loved one, or working into retirement, those are all opportunities to either get a plan in place or review a plan that may already be in place and update it for the new change in circumstances. And at the same time, talk to your tax advisors, talk to your financial advisors, and make sure that you're on the right page with all of them.
Awesome. Very helpful. Any closing thoughts, Joe, before we wrap up?
So it's important to get started. Too many people that I meet with say, I didn't do this and I wish I had done it years ago, or they come to me with a situation where a family member, often it's a parent, didn't do any planning at all. And so they're in a situation now where they're picking up a mess that their parents had left behind, usually unintentionally, but the situation is there where they can't get through an estate, or there's animosity among the children. They are fighting because mom and dad weren't clear about how they wanted things to go and how they should be putting things together for the benefit of the family.
And well, on behalf of us here at the Boston Public Library Fund, I want to thank you, Joseph, for sharing all of your knowledge and expertise with us. I can't believe how quickly our time has come to an end. Thank you all for joining us for this conversation. Later today, we'll follow up with an email that includes the recording of the webinar so that you can reference it in the future if you have any questions. And in closing, I do invite everyone to stay involved and take advantage of the many programs and services offered here at the BPL. There truly is something for everyone and for every interest. I hope to see you all again very soon, and please take care.